Okay, so questions 2 and 3 then. Thanks, Tracy. That's great. And again, let's give Tracy a round of thanks, applause for being willing to share. Okay. And I do really encourage this. I'm hoping that by the time we're done, our whatever it is, 6 months together, 7 months, whatever, that everybody has shared at least once. There's some real value in it. Okay, you get to see your own whatever bias or whatever issues you bring. That stuff all shows up sort of large scale. It's the best chance you have to fix whatever might cause you a problem on the exam. Okay, and it's nothing to be nervous about. Nobody's going to remember tomorrow. Now that I said it, maybe we will, but tomorrow everybody will have forgotten that it's Tracy and Devin who were the first to share, and whatever answers they gave, it all blends into everything else anyways. Okay, that's good. Nobody's judging Tracy for her answers here. All right. So what kind of question do we have with question 2? This is where we have to think about collection, analysis, or recommendation. So is this a collection question, an analysis question, or a recommendation question? What do we have here? So there's definitely a strong element of analysis here. There's even a little bit of recommendation. That's it. I would agree with that, Olu. Now, you're not saying she should do this. You're saying she could do this. And that I would suggest is analysis versus she should, which is recommendation. But it still has that little bit of recommendation flavor to it. So I would say it's still overall an analysis question, but there's definitely a recommendation flavor to it. Okay, so what do we think here? So the concerns, should we have a relationship breakdown? Okay. And Kevin, are you back with us now? Or Kevin, you're back from your break. You said you've done one of these. Do you talk about relationship breakdown when you set this up? Is this an issue that comes up, or do you say, better if we don't think about it? And I'm not prejudging that answer. I'm genuinely curious here. Okay, yeah, that's good. So the ILA, the independent legal advice, would say, advise that there is this loan in place and that we've gotten advice from the lawyer, and the lawyer might have said, you should go and get a better prenup or whatever because of this, right? Okay, so concern here is that first off, Jerry doesn't put the money back in Allison's name. So I think the assumption here is that it's a debt to Allison, and it is. I guess that's not an assumption, that's a fact, right? So the concern here would be that there's no repayment of the debt. Do we like this answer? What do we think about this? Okay, well, maybe you have to be a little more specific than that. Oh, I see. I thought you meant for your answer, Tracy. All right. Well, it is a loan agreement, Stuart, right? So that's where maybe there's a tiny bit of assumption built in here, but I think it's a reasonable assumption. There has to be a loan, right? So it doesn't have to be, Patty. We could leave the loan outstanding Okay, I do like this answer. I'm going to tell you that I fundamentally like this answer. There's a tiny bit of assumption, but I don't think it's a bad assumption here. So it assumes that the loan has to be paid back, which is probably a safe assumption. Okay. So the solution here, that we have an agreement as to what'll happen if they had a marriage breakdown. Is that a valid answer? Do we like that? It probably is, Shauna, a demand loan. That's generally true of spousal loans. And that would be another solution here, Shauna. I agree with that. That would be another solution. Okay. I still think this is a valid answer, and this very much ties into, I think, what Kevin had suggested. I would give the marks for these first two answers. Now, Shauna, to your point, that's a different solution that would also work. Okay, and then repayable prior to whatever separation agreement or whatever we have. Okay, that's fair. Yeah, I think it is. I think the solution is specific enough. There's two different ways you could have that agreement, at least two ways you could have that agreement. Yeah, now, Kevin, I think that's a different concern. I think what you're pointing to is another concern. So let's get to alternate answers in a second. I'd like to work through the answers that Tracy was good enough to share. And then we have some other solutions here from Melanie and Judy and Kevin. So let's hang on to those for a second. So the agreement might be a post-nup, okay, or the loan agreement itself. In either case, is it the financial advisor writing the agreement? No, it would not be, right? In either case, this is going to go to the lawyer to do. And that's why I think this is specific enough for work that somebody else would really be doing. Okay, I really think that Tracy's answer meets the sort of appropriate level of detail here. Okay, well, the color's not good, sorry. All right, that's good. Kevin's very dramatic with his answer here. I like it. Okay, so I would give the marks for this. I think that even though there's a little assumption in Tracy's concern, I still think it's good. I might say, instead of what Tracy gives here, I might say something like repayment of the loan on separation might come into question, but it's essentially the same thing. Okay. Okay, what about Tracy's second answer here, the attribution answer? What do we think here? What's wrong with that, Fatima? What's the problem here? Yeah, that's right. There's no attribution after separation. So as long as it's a real separation, this answer is not possible. Okay, so that's going to, unfortunately, that sort of ruins the second answer as well. If we don't have a concern, then we have this issue. Now, we heard some other potential concerns. Okay, and the other concerns would be if the investment has gained or lost significantly. Kevin, I think this is yours, right? since the loan was made. And again, that just the solution here is just to have an agreement that contemplates that. Okay. Oh, sorry, Stephen, you're on private chat there. Okay. Yeah, now Stephen has a good answer here. It's a pretty complicated thing, but in some provinces, we might have a potential disconnect between the amount invested, between growth on that investment, and between the debt associated with that investment. Okay, those three things are not always treated the same way under matrimonial property law. So this is where we want to properly address this. Okay. Okay. And part of the issue here might even tie to the fact that it's an inheritance. No tax consequences. I knew who you meant, Devin. Yeah, there are no tax consequences if Jerry, you mean post separation, Devin? Yeah, there's no tax consequence to that. There might be matrimonial property law issues, but there's no tax consequence. Okay, there was a couple of other questions here. I think, Judy, your answer is addressed already in what I brought up there from Mark. And Melanie, you mentioned, and a big concern for me here, something that I think is often not well considered and is straight out of the case study, is this issue of inheritance. So what we've probably done here is put us in a position where Allison's inheritance, which is usually protected, not in Saskatchewan, but in other provinces, Allison's inheritance is no longer protected by matrimonial property law. And again, that's where having a robust post-nup will address that. Exactly that, Elizabeth, yeah. So my solution here might be to have this addressed in the post-nup and in the loan agreement. I would honestly probably do this both places. It's just one of these cases where any sort of uncertainty is going to poke a hole in this. And if we have the post-nup that doesn't address it and the loan agreement does, or the loan agreement addresses it and the post-nup doesn't, then we're going to open up the opportunity for some ambiguity. Okay, so there's probably 4 answers that work here. Anybody have any other answers that we should review? Yeah, that's fair, Trevor. Yes, the solution might be the same. So you could have 2 different problems, both with the same solution. Yeah. Yeah, and there's no restriction around that. You don't have to, it's not an exercise in creative writing or something like that. You can, if the solution is the solution, then great, use it all the way through. Okay. That's an important thing to recognize here. What happens on Jerry's death? I think that I wouldn't necessarily make that comment, Melanie, but I think you're fair to talk about Jerry's death. However, that's not an answer to this question, right? So I want to point out the question is specifically about relationship breakdown. Now, I agree, if Jerry passes away, they're no longer married, but that's not really a relationship breakdown, right? So that's an issue that I would want to address, but I don't think it's an issue to address here. Okay. Yeah, now that depends on if he has other secured creditors, Olu, right? So there's always other questions there, but presumably we have some degree of security. Okay. The one other thing that I might point out here, it's a fairly minor point, but it's one of these things that gets to be a point of pain, is what about spousal support calculations? So now, is this considered income for Jerry when calculating spousal support? And again, the solution here is to specifically exclude this in the post-up. Okay, that's good. Or at least specifically address this. Maybe I should say address this. That's probably a better answer because this assumes that we're going to come to one answer or the other. Okay, this would be a fairly common type of question on this exam where you just have a solution, sorry, a problem put in front of you and you're expected to sort of work through solutions for the client. Okay. That's good, Tracy. Thanks. We'll use Tracy's question 3 as well. So what has to happen to prevent attribution? Do we agree with the prescribed rate? Is that fair? Yep. Nice and easy. Does she need to give a whole lot of detail here? Is this enough detail to let us know? No, she doesn't, does she, Melanie? This is what we need. That's it. It's enough of an answer. Yeah. And honestly, going any further than that presents risk. So this is sort of the ideal amount of detail for a question like this. And you can kind of tell this. There's a couple things I've generously bolded. List the, right? Yes, and I'm pretty sure, Sue, that the case study, what does it actually say here? Yes, that is a safe assumption. Okay. Prescribed. Yeah, it's the interest rate. I still think this is a good answer. I know what you're saying here. I should say the interest rate, but it's as prescribed by CRA. I still think you'd get your mark here. It's a fair point. The language is a little imprecise. Yeah. Okay. Yeah, that's a little more detailed, Olu, and that's fair. Okay. Yeah, just a little careless with language. I still think you get your mark. I think it gets where you got to be, but the point about precision here is valid. Okay. What do we think about the second point here? So I'm not sure about this. And what I'll say, I did say that this is something that I like to see. This is a nice to have. And the reason is because it makes tracking much easier. There's no question here that this was repaid, okay? But it's not technically required. And that's where it pains me, because I do like that, but I don't think that, because the question says the specific requirements to prevent attribution. Now, there's a little bit of room for interpretation here, and I might say, well, really, Tracy is making it clear that there is tracking, so I think that this really depends on how the rubric is written. Okay, so yes, the answer is about interest paid by June or January 30th are all good. Okay, I also would support here, there must be a loan agreement. Okay. Yeah, I think you're good, Shauna, with something in that ballpark. Yeah, that's the loan agreement is going to do that, Chris. Yeah. Okay. Yeah, I think you're good as long as you didn't duplicate that with interest paid by January 30th. Yeah. Okay. Anything that refers to that interest paid is good. All right. Any other questions there? All right. Thanks again, Tracy. That's solid. Appreciate you sharing. Okay. Perfect. Let's change gears here. We'll go to PowerPoint. Are there any other questions about the Jerry and Allison question? Anything we should be having another look at there? Any points of curiosity that it raises? Okay, perfect. So we're going to talk here about the corporation and where the corporation sort of fits. Let's bring back the agenda. We're not going to get through the whole thing today, and that's fine. I wasn't necessarily intending to, but we're going to do, I actually have corporate tax review first here. We're going to do corporate tax review, and then we're going to work through the rest of these concepts sort of one by one, time dependent. Okay, so my corporation, now I'm going to start off a little bit at a run here. We're not going to start off from a crawl. So here's what I have. I'm going to have an OpCo and HoldCo scenario. With Lauren as my business owner. Okay. And just to make it easy here, Lauren has 100% of the shares of HoldCo, and HoldCo owns 100% of the shares of OpCo. Okay, everybody's with me here? And this year, we have the following. We have HoldCo generating $40,000 of passive income we have OpCo generating $600,000 of active income. And the question here is, how will that all be taxed? Okay, so the $600,000, now just to see this sort of in a little bit more detail, what we're really looking at with OpCo, for the sake of argument, we'll give it $4,200,000 of revenues. That's the value of all the stuff that we sold or all the services provided to our customers. And then we have $3,600,000 of expenses, which nets out to $600,000 of active business income. And the question with that $600,000 now is, how will that be taxed? Is that fair? Okay, so what'll happen with that $600,000 is the first $500,000 is going to be taxed at exactly that, Tracy, the small business tax rate, which is going to be somewhere between 9 to roughly 14.5%, depending on what province you're in. Okay, for the sake of argument here, we're going to use 11%. You would be provided the tax rates on the exam if you need them. So do not go memorizing all of your tax rates. We're going to use 11% here. Okay, so that means we've got $55,000 of tax at the small business rate. That 11% tax rate is 9% federal plus an assumed 2% provincial. It's a very low tax rate that you get for your corporate income. Okay. And then on everything over $500,000, so that's $100,000, right? $100,000 is the amount over. Here we're going to have a tax rate of somewhere between 24% to around 30%. Okay, we'll use 27% for our sake here. So that's $27,000 of tax at the corporate general rate. Okay, and that's exactly what happens here is on the left side, that means we're going to have in what's called our low rate income pool, we have $500,000 minus $55,000. We're going to have in that low rate income pool $455,000. Okay, and then on the right side, as Olu points out here, we're going to be in the general rate income pool. Oh, thanks, 445. Okay, that's what I said, Mike and Jason. It's just like that on the board. All right, and then our general rate income pool, $100,000 minus $27,000. That's $73,000 that's sitting in our GRIP, our general rate income pool. Okay, so if that's exactly what I'm doing, Mike, if this was all there was, if this is the only sort of stuff happening in this business, then this corporation could pay up to $73,000 of eligible dividends, okay, and they're paid from GRIP. Anything over that is a non-eligible dividend. Now, if OpCo pays a dividend, who does it pay it to? Technically, it's paying it to HoldCo, okay? So what can happen here, in fact, what would have to happen is OpCo can transfer its LRIP and GRIP balances to HoldCo. And there's no other shares. I did 100% ownership there, Kevin, right? So I wanted to make that very clear. No B shares or anything like that. We're 100% ownership, okay? So OpCo can transfer its LRIP and GRIP balances to HoldCo, and then HoldCo pays dividends as if it earned that active income. Okay, and then it can pay those dividends to Lorne. There's no RDTOH here, Trevor. This is so these would be exactly the same types of dividends. So that means Lorne could get up to $73,000 of eligible dividends, and anything beyond that would be non-eligible. Okay. Yeah, exactly, Tracy. It's a tax-free intercorporate dividend based on the safe income rules, which you don't really have to worry about, but just to point out that it does pass. So there's no tax payable here. All the taxes payable when Lorne gets those dividends. Yeah, and exactly that. If for some reason HoldCo chose not to pay a dividend to Lorne, then HoldCo still has a $73,000 GRIP balance. And if it did the same thing next year, then it would have a $146,000 GRIP balance. Okay. So yes, those are cumulative amounts. We generally don't care about the LRIP balance. The LRIP balance doesn't really matter because LRIP only helps us with a non-eligible dividend, which is the less favorable type of dividend, okay? And yeah, that goes on forever, Baljeet. When you have a corporation, you're looking at the entire history of that corporation to determine what your GRIP balance is. So yeah, you can't avoid Part 1 tax, but you can defer Part 1 tax, Olu, right? By keeping money in the corporation. Okay. That's good. Yep, that's true, Fatima. This would be a Canadian-controlled private corporation. And for exam purposes, that's all you really need to worry about is CCPCs. Okay, that means it's owned and operated in Canada. Okay, and it's not a publicly traded company. I'm not sure if I follow, Devin. Sorry. Are you asking? No, it could be more than that. So if I didn't pay out any dividends this year, I build 445 onto my LRIP balance, and next year, if I had the exact same tax year, same tax consequences, now I have $890,000 of LRIP, right? Yeah. So it really is cumulative, right? The $500,000 is the limit for the small business deduction for 1 year. Okay. That's good. All right, let's look at the $40,000 then. So first off, what's the number that I should be thinking about with passive income? There's a threshold that I can run into. Perfect. That's 50,000. Could be rental income. Yep, could be. So $50,000 is where we start to lose access to the small business deduction. Okay, so we don't have that problem here. We're under that amount. But for example, if we had $60,000 of small business, of passive income, okay, and passive income would come from, could be interest, could be our realized capital gains, could be portfolio dividends, which I'll talk about right away. It could be rental income from a passive source. Okay, and passive rental income means that you have fewer than 6 full-time employees. Is that okay for full-time employees? Nothing but shorthand there. Working in the rental business. Okay, and I hope for $50,000 you have fewer than 6 full-time employees. Okay. Or the other thing that's active income, if Holdco, so if Holdco owns OpCo's premises, and you see this quite a bit with dentists, for example. Okay, if Holdco owns OpCo's premises and OpCo pays rent, that's active income. Because really it's the same as if OpCo had just owned the premises itself. Okay, but other than that, that's passive income. All right, is everybody with me there? Okay. Now, let's say for the sake of argument here, so of the 40,000 that we really do have, let's say for the sake of argument that 15,000 is realized capital gains, 20,000 is dividends from Canadian publicly traded corporations, and 5,000 is interest income. Okay, that's all good. Okay, the realized capital gains. We take the $15,000 times our normal 50% inclusion rate. We get to $7,500. That's what's taxable. What about the $7,500 that is not taxable? Creates a CDA credit, which allows the corporation that's perfect. Yeah, Kevin, Olu, and Vaishali all have it. So the $7,500 that's non-taxable creates a CDA credit, which allows the corporation to pay a $7,500 tax-free capital dividend to Lauren. Okay, and if the same thing happened in OpCo, where would OpCo pay that tax-free capital dividend to? It would pay it to HoldCo, and then what would HoldCo do with it? Pay it to Lauren. Okay, that's good. All right, perfect. Now, of the $7,500 that is taxable, what really happens here, this is so ridiculously complicated, but it's what happens. We're going to take half of that, or so we're going to take 7,500. We're going to say that amount is taxed at about a 24% tax rate. That's, in fact, that's correct. We'll use 24% here. And this is our non-refundable tax. So that portion that's $1,800 then. That's paid as tax to CRA. Okay, and it's just gone. You're never getting that back. Is everybody with me there? It's real tax. Okay. Perfect. Okay. But then on top of that, and this depends on the province, but we're going to have about a 26.67%, and really it's like this, okay? Refundable tax. Which is $2,000. That's a refundable tax paid to CRA. And what'll happen here is CRA will hang on to that until you pay the right kind of dividend to get that refunded back. And this is really done until Holdco pays a taxable dividend to Lorne. That's what's going to trigger the refund of that $2,000. Now, in order for this to be true, in this case, Tracy, you're quite correct. Because this capital gain was not taxed as GRIP income. Is everybody with me there? Did we use any GRIP taxation here? We did not. That's true, Baljeet. That's exactly right. So because this capital gain was not taxed as GRIP income, Holdco must pay a non-eligible or LRIP dividend to Lorne to get a refund of its what we call RDTOH balance. The rate of refund, this is refunded at a rate of 38.33% of the dividend paid to a maximum, in this case, of $2,000. Because that was the amount of tax withheld. Okay, is everybody with me there? Uh-oh, is anybody with me there? Oh, Kevin, was that a no to that, or that was an earlier no? RDTOH is not notional, Devin. RDTOH is based on the real amount of refundable tax paid. No, so Fatima, there's no relevance here to no active income and below 500,000. Sorry, I don't know if I'm following your question properly. The reason that this, what's the this in your question, Fatima? What's this refer to? So what triggers the payment of RDTOH is exactly as Sue suggests, the taxable dividend being paid to Lorne, okay? No, 38.33% of the dividend paid, Baljeet, okay? So I've got it on the board here. 38.33% of the dividend paid. Okay. No, sorry. No, it does not have to be $2,000. It could be any amount of dividend. I could pay a $1,000 dividend or a $5,000 dividend or a $100,000 dividend, right? You just take however much that dividend is times 38.33%. And that's how much RDTOH could be refunded. In this case, there's only been $2,000 of RDTOH paid. Okay. I think you're looking for something that's not there, Baljeet. It is exactly right as I have it on the board in red. 38.33% of the dividend paid. Do you see, if we go back to OPCO over here, okay, if this is the only year we're thinking about, how much non-eligible dividend could OpCo pay out this year? Right, so go to OpCo for a second. If I just am thinking about OpCo, how much non-eligible dividend could OpCo pay this year? Up to 445,000, right? So let's say that they do. Let's say for the sake of argument that OpCo pays that up to HoldCo. Okay, so OpCo moves $445,000 of LRIP to HoldCo. Okay, and then HoldCo pays a $445,000 dividend to Lorne. That's all possible, isn't it? And that'll be a non-eligible dividend because it's being paid out of the low rate income pool. So I'd say take that times 38.33%. Okay, and that's just the rate. Okay, that is the rate that's in the Income Tax Act. It's just that simple. I'd be shocked if it's something you had to memorize. I would not suggest it. So that would result in a refund of up to $170,569. However, how much RDTOH would be refunded, assuming that this is the only year where any of this stuff happened for this corporation? Still up to just that max of 2,000. That's exactly the trade-off, Tracy. That's right. So the trade-off is that your income that was taxed at the lower tax rate is paid to you as a non-eligible dividend, so you pay more tax, or if it was taxed originally at the general rate, then it's taxed to you as an eligible dividend, less tax payable. That's exactly right, yes. That's that whole dividend integration thing, right? Yeah, and there is only, in this case, $2,000 of RDTOH, Sue, right? So with only $2,000 of RDTOH, that's what's refunded. Okay, but it could be less. It could be right down to zero. Those are just the rates, Chris. I don't know what to tell you about that. It's just what it is. Okay. Yeah, and in fact, Trevor, this is a big part of what an accountant gets paid for as far as the crossover between personal tax planning and corporate tax planning in owner-operator scenarios. Okay, the accountant is really expected to be tracking your RDTOH balances and making sure that those are getting paid out, or that if there's any amount sitting with CRA, they'll at least have the opportunity to recapture those later on. That's good. But this is a very normal thing, is when you have somebody who sells or winds up a business or dies, the accountant will go back and make sure that we've captured all the RDTOH. So the 24% is fixed, Stephen. Like other tax rates, you're not memorizing these. The 26.6667% varies by province. So that happens to be the rate in Alberta, but in some provinces, that's 26.1667%, or in other provinces, that's 27.167%. There's a bunch of different rates there. Okay, but it's always around that rate. Okay, that's good. Okay. Are there any other questions about this realized capital gain? Baljit, are you with me now on RDTOH? that's generally what you would do here, Baljeet, is pay at least enough to get the $2,000 back, because otherwise you're essentially making an interest-free loan to CRA, right? So I'm not sure what your timing on that question is, Devin. When the RDTOH is returned to Holdco, right? It's going to be returned to Holdco. You with me here? That's tax-free. Then Holdco has that $2,000, and now it could give it to Lorne. If Holdco is going to give that $2,000 to Lorne, how is it giving it to him? It'd be a non-eligible dividend, exactly. And now is he paying tax on it? There you go. Yeah. Okay. Yeah, that's about right, Baljeet. Yeah. Sorry, what's the 7,500? I'm not sure if I answered. Okay, I know what the 7,500 is, Stephen. Why do you suggest a balance here? What's the 1,800 you're taking out? I don't think you're quite looking at that right. There you go, Baljeet. Quick bit of mental math there. That's good. Okay. So if you're thinking about the capital gain back here, is that where you're going? I think you're doing some math that doesn't quite match reality here. Okay. So first off, here's what probably happened to get us here. We maybe sold some investment or land for, let's say, 250,000. We had an ACB on that thing of 235,000. You with me here? I mean, I think honestly, Shauna, there's a lot of people who are in the same boat as you. So whatever you call, whatever you think is best, but I think it's worth sticking around. But okay. But if you want to, yeah, go ahead, whichever. All right. So the we got 15,000 of capital gains, right? You with me here? We have 235,000. That's non-taxable proceeds because it's just the ACB coming back. Excuse me. And that amount, again, Holdco could pay to Lorne as a taxable dividend. That's entirely up to Holdco. So then with the 15,000 of capital gains, that's really where the problem shows up. That's where we're going to take 7,500. And you would almost certainly pay that immediately as a tax-free capital dividend. Okay, your accountant would file a T2054 with CRA, allowing that tax-free capital dividend to be paid. That's easy enough, which leaves $7,500. Okay, that's right. And of that $7,500, 2,000 is with CRA as a non-refundable tax, which leaves $5,500 available to pay as a dividend. And if you did pay that, that would result in a refund of RDTOH. And if you do the math that Baljeet just did, then you see you're going to get that full $2,000 back. Okay, that's all good. Oh, sorry, I apologize. I messed that up. We have 2,000 of real tax to pay. Let's come back to that. Which leaves 3,500 to pay as a dividend. There we go. Okay. So whatever you pay as a dividend, Lauren pays tax on, Baljeet, okay? And to tell you, the $2,000 would be returned to the corporation when there's a dividend paid by the corporation, okay? All right. Yes, to get that, so this is chapters 1, 2, and 3 of advanced curriculum, Fatima, okay? This is mostly chapter 1. Okay? I think everything here is in chapter 1 of advanced curriculum. All right. That's all good? Okay, I don't want to get into the insurance proceeds thing, Vaishali. We're going to talk about insurance in, I think it's month 5 or whatever the case is. Okay. And we'll do a little insurance case study there. Your question would very much depend on what all was going on in the corporation. But essentially, you can pay out the death benefit received by the corporation minus the ACB of the policy as tax-free capital dividends. Okay. Your question, Vaishali, confuses two issues. You're trying to eat the elephant more than one bite at a time. Okay. Remember how to eat an elephant here, and it's exactly what I've done here, by the way. We're eating the elephant one bite at a time. Okay, there is, Patty, yeah, in again, chapter 1 or chapter 2, I can't remember where it shows up, but yes, there is a case study for this. Okay. Yeah, there's a full set of the videos, Chris, from advanced curriculum available. Yeah. Okay. All right, can I erase this whole mess? I'm not going to yet anyways. I'm only erasing my capital gains. Can I erase the capital gains? Apparently I can and more. All right. Okay. It is, Sanjay. It is. I'm not denying that. Okay. Yeah, that's it, Belgi. We've only done a third of our income sources. Okay. Then the next one is actually easier. Although people don't want to believe me on that, it's a true story. So then I have $20,000 of dividends from publicly traded Canadian corporations. How was that income taxed before it landed with Holdco? If it's a dividend from a publicly traded Canadian corp, how is it taxed? It's public, so it's always eligible. That's right. So Perfect Natalia was taxed at the corporate general tax rate. Okay. Knowing that, would it make sense for Holdco to pay tax on this again? Or if Holdco pays tax on this again, what's happening here? That would be double taxation, wouldn't it? So there's no income tax payable, no Part 1 tax payable by Holdco because this thing has already been taxed. If Holdco gets this $20,000 in 2020, for example, and pays it to Lorne in 2020, is everybody with me here? So Holdco gets the $20,000 and pays it to Lorne in 2020. Then Holdco pays no tax. And how is Lorne taxed? Perfect. Lorne is taxed on an eligible dividend. It's a GRIP amount. Because this amount was taxed at the corporate general tax rate. Okay. Does that make sense? That's effectively what's happened here, Devin. It's a flow-through mechanism. Okay. Now, I'll show you a less likely scenario, but still possible. So in my less likely scenario, here, Holdco gets the $20,000 and hangs on to it, doesn't pay it to Lorne this year. And what would happen here is we take the $20,000 then times 38.33%. That is our withholding tax rate. And therefore, we would pay that amount to CRA. That's $7,667 paid to CRA as a refundable withholding tax. And what has to happen to get that refundable withholding tax back? Need to pay a dividend, and it has to be exactly that, Belchit, an eligible dividend. So here, Holdco must pay a $20,000, right? If you take that times 38.33%, eligible dividend to Lorne to recover that withholding tax. Okay. They're really both the same outcome, aren't they? What I did in pink on the left and in blue and red on the right, they're the same outcome. It's just a difference in timing. Or really, Devin, you could ask, when do you want to pay the 20,000, right? Okay. Does that make sense? That is easier than the capital gain, isn't it? Yeah, now ultimately, Sanjay, who are they going to collect their taxes from? Who is really the taxpayer in this case? It's Lorne, right? Okay. Perfect. Now, the interest income or rental income for that matter, although I didn't throw any rental income in here, but interest income, yeah, could be indefinite, Baljit, yeah. Or rental income, which means you're indefinitely giving an interest-free loan to the government of Canada, right? Yeah, that could happen, Baljit, if you needed the money for some other reason, then yeah, you might hang on to those dividends and not get your RDTOH until a few years later. Yeah, I'd buy that. Okay, so my interest income or rental income, same thing here, that's taxed the same way as the taxable portion of a capital gain. Okay, so once again, you would have a 24% real tax rate that's non-refundable, and then a 26.7%-ish refundable tax rate. And on that 26.7%, again, you need to pay a non-eligible dividend to Lorne to recover this at a rate of 38.33%. Okay, that's good, just like we did before. All right, that could hardly be easier, could it? So yes to the first half of that question, Mike, and no to the second half. And honestly, you would have no time. What you really want to do, though, is pull out a piece of scrap paper and just walk through it yourself. Walk through it a few times as if you were teaching it, right? So just take a blank piece of paper, a whiteboard, whatever, and just walk through it a few times. You'll get it, okay? Yeah, it's the best way to learn something, Mike, right? Is by teaching it. So, oh, there's lots, Devin, and in fact, the homework this time doesn't quite have this on it, but you have to really speak this language. So I'm more concerned here, Devin, that you understand the language here than I am about you being able to recreate each individual concept. Are you with me? I think it's highly unlikely that you have a question that purely asks you about the amount of tax payable on a portfolio dividend or on a passive dividend. But I think it's highly likely that you have a scenario where you have Lorne and his holdco, and you have to really understand all the sort of building blocks to that in order to be able to help him with an insurance need or to be able to help him with a succession planning question or something like that. Yeah, very similar to Devin's question here, Sanjay, and I still stand by my answer. Okay. I think you're not likely to do a pure calculation of dividend income. Okay. But if Lorne is my client, I sure have to be able to help him figure out whether he should be using his holding company to invest or whether he should be using his, let's say, RRSP or non-reg personal account or TFSA to invest. And you see that, Sanjay, if I don't understand how that capital gain, dividend, interest, rental income is taxed here, I can't answer that question, right? Okay. Well, we'll get there, Baljeet. We'll get there. I mean, you know already how Lorna is taxed, right? You know your marginal tax rates, you know dividend gross up in credit. We in fact did a dividend and credit question already today. Okay. That's good. Perfect. Yeah, Lauren, is that nice to have client, right? Okay, let's look at share sale or asset sale when we're selling a business. Now, I don't want to get too much into the full-on tax consequences. I have a slide for this later on. I just want to generally talk about what happens here. So when a business is being sold, there are really two fundamental ways that it can be sold. I don't seem to be taking me up on my recommendation here. I know I always recommend this podcast. I like it so much. Built to Sell Radio. Do we like this podcast? Anybody with me here? Anybody listen to this thing? If you're wanting to be in this market, Sanjay, this is how you can learn to speak the language of your business owner client. Okay. So you say, I want to be working more with that, you know, mid to high net worth business owner. Honestly, this thing will pay for itself. It's like a little MBA in your iPhone. Okay. Completely free, like many podcasts. And he goes through this question with business owners. He talks to them about how they sold their businesses. And in fact, I was just listening to an episode either yesterday or the day before, and this exact question comes up in there about share sale versus asset sale. And they very much go through what I'm about to show you here. Okay, it's a very real thing. And I really cannot recommend this thing more than any other resource for people who are operating in or want to operate in that small business owner market. Nothing to do with the exam, but it will make you more comfortable with the language. Okay, so in a share sale, the idea here is the business owner sells their shares. Oh, I've never looked at the app. I'll check it out, Sanjay. All right. I've listened to every episode. I've never heard John talk about the app. All right. Okay. Right. That's exactly it, Tracy. So the business owner sells their shares. Okay. And the idea here is if they own them personally, they can use the lifetime capital gains exemption, which is often attractive here. Now, if it's a holdco structure, this may be unavailable. So this is actually a pretty common sort of problem. I knew what you meant. Okay. So if you have this kind of thing, like we just had, in fact, with Lorne. So if I have Lorne here, And I've got Lauren owns 100% of OpCo, or of HoldCo, sorry, and then HoldCo owns 100% of OpCo. Just like that. You with me here? Then if HoldCo sells OpCo, there is no lifetime capital gains exemption available. And why not? Because HoldCo is not a person. That's exactly right. Okay. It has to be a person. Now, if Lauren sells HoldCo and OpCo as a bundle, then the lifetime capital gains exemption may be available. Okay. However, this is not a very common thing, because normally the reason we have HoldCo is to own passive assets. And with HoldCo owning those passive assets, we get a little bit of a mess here. That's exactly it, Pamela, right? So, so HoldCo owns passive assets. Okay. And a buyer generally doesn't want to buy your passive assets. And then the other issue is that now you're likely to fail the 90% active assets test that you need to meet in order to be able to use the lifetime capital gains exemption. Okay, and we'll talk about that more in a couple slides. Okay, that's all good. Now, other than that, the business owner likes this because all gains are capital gains. So you have the 50% inclusion rate, and you get rid of the corporation, which means that you likely reduce complexity and you have that cash in your hands personally. Okay. Yeah, that's exactly right, Mike. 90% in the 24 months prior to sale. And then, sorry, I apologize. 90% at the time of sale and 50% active in the 24 months prior. Okay. Yeah, exactly, Tracy, exactly that. There's no more liability. The buyer assumes all liability. Okay, that's all good. Okay, so generally speaking, a share sale is preferred by the seller. All right, an asset sale is the more common way to sell a business, at least outside of family transactions. So what happens here is the corporation sells its assets. The owner then still has the corporation post-sale and now has to take dividends out. There's no use of the lifetime capital gains exemption here. In a normal asset sale, there are ways to do this, but they require some fairly creative tax planning. Okay, really tax planning is beyond the scope of this course. And The owner, to your point, Tracy, still has their any liability. So if a year later a customer has a product that whatever blows up and hurts them, that's your liability. Or if a year later a staff member decides that they were harassed and sues, that's your liability, or really that's the corporation's liability. So in that sense, you're still dealing with all of these issues. Okay. So you could wind up the corporation to do this, Baljeet, but yes, there still is liability for a period of time after that. That gets into a fairly complex legal question where we'd have to look at how you took money out of the corporation when you wound it up. But yeah, it is possible to sue a wound up corporation. And then what you're essentially going to try to do here is to prove that that business owner knew that there was this potential liability, enriched themselves anyways. You're going to make probably an unjust enrichment argument around those dividends. Okay. So this is where the big tax problem here is that any sale of assets by the corporation results in a recapture of depreciation. And this can be fairly expensive, depending on the type of assets the corporation owned. So the buyer generally prefers an asset sale and the reason the buyer prefers the asset sale, it's a clean start from both a tax and liability perspective. Okay, that's all good? So in general, you're more likely to see a share sale in the following circumstances. First off, where the seller is providing the financing. This is what we often call a vendor financed arrangement. So if I don't have all the money to buy a business, but the party that I'm buying it from is willing to help me out, then we have the buyer or the seller, sorry, is going to set the deal the way they want it. Okay, we also see this where where it's a family arrangement. That's pretty common here, which often goes hand in hand with the seller providing the financing. We also see this where it's a very large company buying a smaller or a much smaller company. And the reason is because they typically have lots of legal protection in the form of both due diligence and covenants and warrants, where they've really said to the business owner, look, if there's something we don't know about that comes back to bite us later on, you're going to pay for that. We're not actually going to really assume that liability. We're going to pass it back on to you. Yeah, so Devin, quite often where you see that sale of shares over several years, that's in those vendor financed arrangements. Very common in family situations to see that. You also see that in vendor financed arrangements where there's a senior selling to a junior. Okay. And in fact, I actually was part of a consultation process yesterday, weirdly, for one of those deals. Okay. What's less likely here, sorry, I apologize. Fix that up. Yeah, that's right. You could use an estate freeze as part of that, Baljeet. Agreed. Yeah. So the asset sale is more likely where you have sort of a mid-sized business buying out a smaller business. You'll see this quite a bit where with companies that have a lot of physical assets, okay, as opposed to intangible assets where the value of the company is more about, let's say, processes or about some intangibles, then you might see a share sale. Okay, so we're going to talk about that on the next slide, Sue. All right, that's good. That's my 25-cent word for the day. All right, good. Okay, perfect. So now let's have a look at valuation. Now, I have a couple comments about valuation. I don't want to go down a whole garden path here. If I'm dealing in a non-family situation, okay, arm's length, I don't know what we call this now. Arm's length has become something else, I guess, but 2-meter length, whatever it is. So in a non-family situation, no, I would not suggest that, Baljeet. Service industry business is still most likely asset sale. Do you mean like an accountant selling their practice? Is that what you mean by service industry? Yeah. Advisors, accountants, they all sell assets in most cases. I'm sure there are a few people on the call who have been involved in acquisitions of other people's businesses. But I have that right? And typically, you're doing an asset sale here, asset purchase, Mike. Is that fair? Very rare to buy another advisor's corporation. Because, Baljeet, really what you're buying there, you're buying very clean. You're buying the block of insurance business and the block of investment business, or the book of insurance business and the book of investment business. You're not buying that person's processes. You're not buying their IP. You're not buying anything like that. You're really buying those sets of assets, the right to generate passive income on those assets. That's fair? Okay. Typically, the only time I see share sales done in advisory or other professional practices like that is exactly what I talked about a few minutes ago, where you have a senior who says to a junior, look, if you want to buy me out, this is how it's going to be. That's good. And that does happen in this business a little bit. Jason, I don't know if you see that. Do you deal with some of your Macs when they're going through that transition, Jason? And that's a case. So a MAC is a multi-advisor corporation. It's a bunch of people who are incorporated. And that's one case where you do sometimes get because it's already a corporate structure and you get one junior who's buying out one senior or some transition like that. Is that fair, Jason? Yeah. Okay. Perfect. So you're right to equate this to advisory practices, Baljeet, and advisory practices do reinforce, I think, what I've said about this. Okay. Okay. Yeah, that's one, Jason, where it gets a little murkier, doesn't it? You can have both then. You might do a share sale there, or you might do an asset sale. That really is a case by case. Okay, so in a non-family situation, here the price is the price. Okay, you have two parties both negotiating with their own economic interest at heart. Yeah, that's for sure, right? Okay, that's good. So both parties both have their own economic interest at heart. Here, whatever, we don't care. CRA won't get fussy about the price. They say what you paid is what you paid. Okay, is that all good? There's no need to fight about this. Now, to your comment, Sue just mentioned this concept of goodwill. So I'll use an advisor situation to show you goodwill. So let's assume, and I don't know what the multiples are today, but let's assume that practices are selling for 3 times passive revenue. Sorry, passive income. Is that fair? Or 3 times passive trailers? If I use that, is that okay? We're going to go with it. Okay, so essentially, okay, thanks, Val. Perfect. So now you have the choice. You're looking to buy one of two practices. Okay, 2 practices are for sale in your region or whatever the case is. Practice number 1 has, let's say, $100,000 of annual trailers, okay, annual passive revenue. It has, let's say, 1,500 clients and average household net worth, and I don't know if you'd know this with an insurance practice, but let's say we do. Average household net worth is $250,000. That's good. Or I have practice number 2, which also pays $100,000 a year of trailers, but this one has, let's say, 80 clients. And here we have average household net worth of, let's say, $1,400,000. Okay. So which practice is more attractive? Which one would you rather own? Okay, there might be a small number of people who would prefer number 1, but I think the majority of people would prefer number 2. So in fact, you might actually have to pay maybe $300,000 here. You might have to pay a little bit of a premium to get number 2. You might pay $350,000. Is that fair? At $350,000, does that still look like a good deal relative to number 1? So let's say you do pay $350,000. But what you're really going to do here is you're buying assets. You're buying $300,000 worth of passive income. So that's okay. Your accountant can take care of that. But the other $50,000, well, it's hard to account for that. And that's where we're going to call that goodwill. So what you're going to have here is a goodwill line item for $50,000. which really means you paid more for an asset or a business than its value on paper. And that's all goodwill is. So when I see goodwill on a balance sheet, it says one thing. It says that this business has at some point bought the assets of another business. Okay. That's good. So when we talk about goodwill, it's really just that. It's just an accounting trick. Okay. Yeah, because it's essentially the accountant just trying to make up for a price that maybe didn't make sense on paper, Sanjay. Okay. Yes, it's a non-tangible thing. It's depreciable. That's one of the curious things about goodwill. It's a depreciable asset. Okay, and that's kind of true. If I don't take care of those 80 clients, they lose value, don't they? Is that a fair comment? I got to put some work in on those folks. Okay. Now, valuation is a bigger concern in a family situation, a non-arm's length deal. That was the whole premise, wasn't it, Mike? Okay. I really did try to give a scenario that everybody could identify with. Yeah, that's some people might prefer that, Baljeet, right? Some people might say, well, I like that middle income market more. I'm more comfortable there, and that's fine. But I think most people would prefer number two. And when I polled, that's what came up, right? So I'm not suggesting 100% of people prefer that, but okay. So in a family situation, the problem here is the price may not be the price. That is, you might have one party who is willing to give the other a break. Okay, and really because they probably have some degree of shared economic interest. Would you agree with that? Okay. And because of this, CRA will not take it for granted that the price was the right price. Okay. If the price that the family members paid does not match what an arm's length party would have paid, we get double taxation. Okay, so I sell my business to my kids. Let's say for $800,000, but I could have sold it to a stranger for $1 million. Okay, now there's an exception for farming here. Ignore this for farming. And fishing for that matter. There is no problem for farming and fishing. Okay, and that's exactly the concept here, Jason, fair market value, right? So the $1 million is what we would call fair market value. Well, what'll happen here is CRA will tax me as if I sold for $1 million. That's good. And my child will have an ACB of $800,000. So I don't get the benefit of selling for a price less than fair market value, and my child doesn't get the benefit of paying a price less than fair market value, at least from a tax perspective. Does everybody see how that's double taxation? Right, so this is a little bit problematic today, Elizabeth, because there is an old interpretation bulletin that talked about that. I want to say IT 94. I believe that's correct. Okay. But the interpretation bulletin has principles, and those principles are still used. So CRA, even though the IT is out of date, CRA still uses those principles in valuing a business. And those principles are tried and true. They really do match what you'd see in practice. Okay. And again, it only really matters, Elizabeth, if you're buying from a family member, right? If you're buying from a stranger, well, so then it does matter. So that's where, if you want to really be bulletproof, you would go hire a business valuator to get that proper evaluation. And there's a couple ways to do this. I can show you this. In fact, I actually have an email in my inbox right now with a certified business valuator. He's going to join me for my podcast in the next little while here. So yeah, CBV is a certified business valuator. And they can value a business in this case. Okay, or you could hire, there's a couple of firms in Canada. I only remember one of the names right now, I apologize. But you could hire so in your case, you could hire a financial services broker to value the business as well. I don't know, so I know who's doing this. I know Queenston Consulting out of Winnipeg will do this. I think maybe he'll still do it. I'm not sure. Jay Arul out of Edmonton might be doing this. I know he was doing this for a while, but I can't remember if he's still doing it or not. Okay. So a couple folks. Queenston they're right in the heart of this. And there's another one. I just can't remember the name of them. If anybody knows, let me know. I don't want to shortchange anybody here, but that's what I would do. Okay, and that takes the risk out. And yeah, it's going to cost you. It's probably going to cost somewhere between $5,000 and $10,000, but you want to take that or get that certainty added in, right? Okay. Any questions there? All right, I'll take the last couple minutes here to show you again where the homework is. Okay, and we're going to go to CFP exam prep. Right there, everybody's with me. The nice thing is, of course, you'll only have maybe 4 or 5 courses. I have so many. So you'll have CFP exam prep. You're going to go there. And in here, you're going to go to the webinar recordings and class notes. I think I'm going to just change that to say end homework. There, that's so much better. All right, there we go. And then you can just scroll down and you'll see the homework for day 3 right here. Okay. And when I have the screenshots and the recordings up, they'll sit right here. That's good. Okay, and then the other thing you might care about is if you want to go back, I think Mike, you had suggested you might want to go back and watch some of the older videos, and you can go here to exam prep content review. That's the whole course front to back. It's every resource that a student who's going through the program has access to. And for the stuff we did today, So I haven't heard that yet, Patty. I have been talking about, I know that they have been discussing how they're going to handle exams if the COVID issue becomes a problem. There are technology solutions that are available for this. It might drive up the cost a little bit. We'll see what happens here. Okay, so I haven't heard a firm plan yet, Patty, but I know that it's a big concern. We can't go a whole year without having the exam, right? So yes, I am in regular contact with FP Canada. Oh, so there's companies like Proctor U and Prometric have Proctor at Home solutions. Yeah, so you turn your camera on and you agree to the tracking software to work. Yeah, exactly, Mike. Yeah. And then there's a human being who's watching you in an office in Delaware or whatever. Okay. Yeah, it's true, Jason. Yeah, LOQP is on again in most provinces, actually, to some extent. I think Manitoba's a little, no, sorry, Jason, where are you? I can't remember. Not in BC yet. Yeah, yes. BC's, Alberta was better equipped for this, honestly, because you have that massive right at the Harbor Center campus. It's been very hard to make an alternate plan for that. Okay. Yeah, the stuff we did today is all down here in advanced curriculum. And you can just pop in here. And there's a super robust set of videos here if you want to watch it. The chapter 1 videos. It's this, oh no, where is it? Sorry. I gotta find it. Okay, anyways, somewhere in here. I'm concerned that it didn't show up in here. There's a set of videos that is all about no, I'll find it. All right. Okay. Yep, you sure do, Jason. Yep. It's just in the same course. It's in the same exam prep content review. Okay. Yeah, and I do have newer videos, Chris. I'm just looking for the right set here. Okay, I'll track it down. I'll make sure it gets in here. At some point, the new videos will be there. I have like an 8-hour series that's just a case study of 3 people who start a business together, grow the business, sell the business. Okay. It's too many videos not to have them show up on here. All right. Okay. Perfect. Okay. Nice, NJ. All right. No, I can't see it right now. We'll get it on there. All right. Yeah, we'll get them in there, Sanjay. Okay. Perfect. Well, everybody have a great one. We'll see you again. When are we here? On the 12th of June. Yeah, thanks so much. And yeah, I hope people do feel, I hope people feel like it's worth continuing to get ready for this exam, that this is a solvable problem. Okay. Appreciate Tracy and Devin sharing answers today, and I appreciate lots of good questions from the crowd in general. Okay. That's it, Olu. Yeah. All right. That's what it should be, firing on all cylinders here. Okay. Everybody have a great one. Thanks so much.